Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And so let's get into today's episode. And it came about because I met a client that has actually just engaged my firm to help him provide holistic advice, tax services, build a financial plan, invest monies, these sorts of things. But I actually met the client 10 years ago. And the client decided at the end of the day, look, he'd prefer to go and engage an advisor that was, in close proximity where he lived. So he lived in Queensland, we're in Victoria. He thought, look, I prefer someone that's sort of down the road. Anyway, as it ended, he never ended up engaging a financial advisor and managed his investments himself. And so, but now he's had a bit of a change of heart. He's realized that, having the right advisor is far more important than just choosing someone based on pure convenience. And of course, he's decided to engage our services. Now, despite not having an advisor over the last 10 years, he has accumulated a significant amount of wealth over the past decade, particularly in a share portfolio, which made me initially think, wow, he's done quite well. Maybe he doesn't really need our advice if he's done so well by himself. But as we dug a little bit deeper, it became clearer that there were some fundamental mistakes that have certainly cost him a lot of money, a lot more than what he would have paid in advice fees, of course. And, these mistakes would have been avoided by any, good advisor sort of steering him clear. And so it got me thinking, what exactly does an advisor do when they manage a share portfolio? Now, of course, we talk in this podcast about a lot about strategic advice, financial planning, projections, all these sorts of things. So the strategic element to it. And I get that. There's a lot in there. I talk a lot about property investing and the strategies behind there and structuring and tax and all those sorts of things. But I thought I wanted to hone in and just talk about managing a pool of assets. Now, in the share market and bonds and fixed interest and could be infrastructure, all those different exposures. And that portfolio could be inside super, it could be outside super, it could be a combination of these things. But when we have a pool of liquid assets that we're investing, let's put it in inverted commas in the share market, what is it that an advisor can do for you? And I've identified four kind of main areas, but of course, the primary benefit is that you hope to receive more than you pay. So that is that the advisor will help you achieve better returns compared to what you would have been able to achieve without the advice. Now, I guess that's what you need to decide too when you're making that analysis is you need to work out, well, what can I do by myself? What could I achieve by myself? And then if I go and pay a fee, what return would I achieve? And you want to make sure, of course, that you'll be better off net of the fees concerned. Now, of course, if you think you're going to beat the market and you're going to be the best performer in terms of running an investment portfolio, well, all the power to you. But, I think I shared the research a few weeks ago in January, in fact, about active versus passive. And even if the professional fund managers can't beat the index over the long run, I would argue that you as an individual with less experience has a lesser chance. I guess a more rational, disciplined investor, hopefully the kind that listens to this podcast might think like a simple approach of maybe putting 50% in a Vanguard Australian share fund and the other 50% in a Vanguard International share fund. Maybe that's an approach that you could take without advice. Well, if you look at the long-term return since 1997, since those funds began, that strategy or that approach would have delivered a little over 8% per annum. Look, I think conservatively, and we want to be conservative this, I think most people could earn 7 to 8% per annum without much in the way of advice. So you certainly want to be able to achieve better returns than that. And I think that's a realistic benchmark, if you like. Now, of course, when measuring the value of advice, you've got to then think about how much is the advice going to cost you relative to the portfolio and performance. If you've got a $10 million portfolio and you're paying a fixed fee of $10,000 a year, you're probably going to be paying more than that, but you don't need just a small percentage increase is going to more than pay for the fee. Whereas if your portfolio size is say 200,000 and you're not really contributing much in the way of capital, additional capital to it, I mean, even the tiniest fee for financial advice, I think the minimum fee most advisors charge is somewhere like $3,000 just to cover their costs, it still wouldn't be worth paying $3,000 to get advice on that portfolio. So, of course, the amount invested has a big impact. Okay, so let's get to today's podcast, which is what are the 4 things that an advisor is going to do for you that is going to add value over and above what that benchmark looks like. So the first one is portfolio construction, which is just another sort of technical way of saying the advisor is going to use a whole combination of investments, different strategies that are getting access to different geographical markets, different sub-asset classes as well, that hopefully exposes your portfolio to less risk but more returns. So, for example, I talked about kind of a benchmark portfolio of 50% in Vanguard Aussie and 50% in Vanguard International. Now, that's a pretty bland portfolio. It's very broad in terms of just traditional market cap indexing. And that's the only indexing strategy it relies on. And it's a quasi growth strategy, if you like. The large cap stocks have really driven most of the returns, particularly over the last couple of years. So for this strategy to continue to work, those large cap stocks really need to continue to drive those returns. And if you are investing 50% Aussie, 50% Vanguard, essentially 1/3 of your fund is concentrated in just 20 stocks. That's a lot of concentration. And we know that, sectors of the market like large caps can't outperform forever. Of course, that doesn't make sense. We know mean reversion will kick in at some point. So that strategy has some risk. Although we go and look back over the last 20 odd years or more since 1997, its performance has been relatively good, but that's probably been helped over by the last 10 years where the US stock market and particularly those US large cap stocks have done really well. And really, when you look at it, although growth, and I said that market cap indexing is a good quasi for growth because the amount you're investing or how your investment is allocated across a particular index is linked to share prices. So as the prices of Nvidia, for example, in the US has continued to increase, it represents more and more of your portfolio and they're growth stocks, and those growth stocks have done really well. But when you look at data, particularly in the US, dating back to 1927, so nearly 100 years of data there, value stocks over that period of time have outperformed by 4.4%. Now, when you look at the last 10 years, again, because they're large cap stocks, value is underperformed by about 5%. That's a 9% turnaround. So this is an very unusual period of time. So I guess what I'm arguing here is if you just go traditional market cap indexing and you just go a sort of vanilla 50-50 Aussie International, whilst you look back over the last period of time and go, that worked okay, the risk is that it's not going to work as well in the future, and that a good advisor will then look at a portfolio, and particularly if they use an evidence-based approach, a low-cost evidence-based approach, they're going to say value will eventually have a resurgence. We need to use strategies that break the link with price. That is, that we want to allocate our investments across a particular index using something other than share price to expose the portfolio to better future returns. Okay, so that's the first thing that an advisor is going to help you with in terms of portfolio construction, which is sort of structuring maybe an existing capital, the amount that's already invested, and then if you invest new capital. The second thing is sort of ongoing portfolio management. And there's a few facets to this. I mean, there's many facets, but some of the key ones that I really think about, probably or arguably the most valuable thing an advisor is going to help with is stop you making stupid decisions. So that is decisions that tend to be based because of fear and greed or driven by fear and greed rather than investment fundamentals. Look, a lot of people call this behavioral finance, for instance. And, sometimes just, there's a huge amount of value just helping people, stop making decisions they shouldn't make. And that could be selling investments when they should really just hold on and ride out the volatility. That could be, making an investment when, we think that's just too risky. And sometimes it could be, just encouraging a client to do nothing. I had a conversation recently about, a client asked me about Trump and what President Trump might do in the US and how should our portfolios accommodate it and those sorts of things. So you can jump at shadows, these sorts of things. Sometimes you do need to react. Often you don't. It's really just taking that long-term evidence-based approach and keep clients on the straight and narrow. The next thing is about portfolio rebalancing, and that happens because different investments are going to grow at a different rate over time. And so if you don't rebalance, what happens is you end up being overexposed to overvalued markets and underexposed to undervalued markets. And so every now and again, you need to make sure that your portfolio is relatively well balanced and you're happy with the balancing. And if not, then you might have to actually sell some investments that have performed really well and reinvest those monies in asset classes, geographical markets, whatever it might be, that exhibit better future returns. So it's really about reinvesting profits, if you like. Now, of course, that said, it's really important to minimize turnover as much as possible, because if I go and sell an investment, I'm going to trigger some tax consequences, I'm going to trigger some fees and so forth. And we like to make sure as much as humanly possible that we minimize those sorts of transactions. So where possible, what we like to do is use new money. So if clients are making regular contributions into a portfolio, we will use them to rebalance the overall portfolio. So we might, for instance, invest 100% of the money that comes in this year into the Australian market. We probably wouldn't do that. That's a poor example, but something along those lines in order to achieve that rebalancing. But there's a lot of studies around rebalancing that shows that it really does reduce the portfolio risk and ultimately in the long run achieve better returns, because not every market is going to run forever. Now, whilst we like to avoid tax as much as possible, sometimes some investors can be too focused on capital gains and end up making poor decisions. So, I'll give you an example. Consider CSL is a really great example. We've got some clients with large exposures to CSL, mostly because they've inherited portfolios from family members that might have bought CSL when they were first listed in the 80s, I think it was, and would be sitting on, or maybe early 90s. Anyway, be sitting on large capital gains, and that would trigger, a lot of tax if they made some changes. But here's the dilemma. CSL share price has really traded between $200 and $300 for the past 5 years. It pays a pretty meager dividend, I think about 1.5%. So really investors haven't earned much in the way of returns. And in fact, if you overlay or take into account inflation, they've probably gone backwards. So what do you do in that situation? Do you sit on your hands and not do anything and risk earning zero and even worse, losing money over a period of time? Or are you better off to pay some tax and rebalance a portfolio, reduce that concentration risk and invest it in a way that exposes the portfolio to better returns and lower risk? I don't know what the answer to that question is, because there's not a one-size-fits-all question, and it's not a black or white question either. It's not sell everything or sell nothing. It's really about finding a balance. And I think, in most situations like that, we'll have a strategy. How much will we sell over the next 5 years? How will we balance out and try and minimize some of these tax benefits? But managing the portfolio on an ongoing basis, both in terms of rebalancing, reducing concentration exposure, and then also just really helping around that behavioral finance element, I think can add a substantial amount of value to the right clients. Okay, the third element they're going to help you manage is risk, portfolio risk. And I think this is a really important one, because something that easily overlooked by a lot of investors is how much risk is sitting in a portfolio. Now, I define portfolio risk as the risk that your portfolio fails to achieve the benchmark returns over the next medium to longer term. So that is, if I'm looking at a portfolio, is this portfolio going to deliver 8%, 9% returns over the next 10 years? Now, if your portfolio is heavily weighted to asset classes that have outperformed over the last 5 to 10 years, then I would argue that the portfolio is carrying unnecessarily high risk. That is, that the probability of underperformance over the next decade is too high. And that's how I think about portfolio risk. And, it's a little bit like going to the casino and knowing when to leave. You leave when you're in a profit position. If you stay any longer, the casino will work out a way to get that money back again. Recently gold's an excellent example. In Australian dollars, because the Australian dollar has devalued over the last 12-ish months, the gold price has surged in Australian dollars over 40% over the last year. And over the last decade, it's delivered 10% compounding returns, which is more than double its long-term historic return over the last century. So around about 5% it normally appreciates by, but it's doubled that return over the last 10 years. So sure, the gold price could continue to rise, and really no one knows when it's going to peak. But the probability, for example, of it rising another 10% on average over the next decade is really low. And if I own gold today, I think I would take my money and run. I would sell it and reinvest those monies in an asset class that didn't appear so heavily overvalued. And we've got to think about risk more and more as we get deeper into our investment journey. The closer you are to retirement, arguably the less risk you should take, because preserving capital becomes as important, if not more important, than delivering higher returns. But even if you're not close to retirement, the thing I think about is, why take the risk? If you can build an investment strategy and that investment strategy works perfectly well, if you're able to achieve 7 to 8% returns per annum over a long period of time, why take the additional risk? If you're not going to be rewarded for it, if your life's not going to change, why would you take the risk? And the way I think about it is, why not just lock it in? Why not invest in a way where I'm really sure I'm going to be happy with the returns? Because the reality is that there's going to be other people out there over the next 5 years that are going to beat you in terms of returns, but it's really difficult to beat an approach like that over many decades. And in 20 years' time, people look back and go, slow and steady was the right way to go. And I'm not suggesting we should be really conservative, ultra conservative. I'm just saying that use an approach that is aimed at making sure we're going to at least deliver 7 to 8%. Probability is, and the evidence in fact shows us, that our returns are most likely going to be higher. But I guess what I'm trying to demonstrate here is you've got to consider both risk and return at the same time when making investment decisions. Just looking at investment returns alone will invite you to make some pretty costly mistakes in the long run. So that's another thing I should say that an advisor is going to help you with in terms of managing a portfolio is de-risking the portfolio. And ironically, by tilting a portfolio towards assets that are undervalued, towards markets that exhibit better opportunities for future returns, the ironic thing is that whilst you are taking lower risk by doing that, the probability is over the next decade, your returns will be above average. And so you can almost tick both of those boxes in terms of earning the highest return for the lowest risk. And the fourth benefit that an advisor can deliver is tax efficiency. At the end of the day, the goal should be of investment advice to maximize returns on an after-tax basis. And this distinction is really important because at some point, whether it's you or your beneficiaries, investments are most likely to be sold one day, and that tax will be triggered. And so after all, the whole point of investing is so you can put yourself in a position where you can spend that money, whether by bequeathing it to your family or spending it on your own life and enjoyment and so forth. And that's why tax efficiency is so important. Now, one of the mistakes that this client that I met again after 10 years made, he was attracted to products that were heavily marketed with potential tax benefits. And unfortunately, those products tend to be very poor. Quite often, not always, I'm going to leave room for the possibility there are some products out there that are fundamentally sound and not too expensive. But quite often, products that are marketed with a tax angle are a symptom, not a cure. They're a symptom of poor structuring from the beginning rather than a cure to tax planning or a substitute towards tax planning. So things like investment bonds or dividend substitution plans, these sorts of things have been developed by, they call it financial engineering. It's the stuff that a lot of investment banks do. And it generates a lot of money for the people that are doing that work. But ultimately, those products aren't necessarily focused on delivering great outcomes for the end investor. And that's why we will always, when structuring things like this, we always work closely with the tax team because they're always going to have very valuable input from their perspective. And because tax is a big element, we want to think about, how can we invest in a way that's ultimately going to give us the ability to minimize tax not only today, but in the medium and also the long term. And particularly if we want to one day convert this portfolio into something that's going to give us an income, or a steady amount of sort of capital income to help fund living expenses and retirement, how are we going to do that really tax effectively? And so if I go back to this client that I met, we would have taken a completely different approach that would have ultimately saved him a substantial amount of money. I haven't quantified it, but making sure we deliver on that tax angle would have paid for our fees over the last 10 years easily, just by itself. So I guess just to sum up then, an evidence-based advisor is going to construct a portfolio using various rules-based indexing strategies, low-cost strategies, aimed at ultimately achieving above average returns over the medium to long term. They'll prevent clients from making poor investment decisions, proactively minimize tax, and mitigate investment risk, particularly portfolio risks, as much as possible. Now, of course, it's impossible to quantify, how much value can an advisor add. I know there's plenty of studies out there on the internet, so you can certainly search for them. But of course, it really depends on the client. What returns could have they achieved without the advice versus with the advice. And on top of that, there's going to be, of course, the advisor and the quality of the advisor and the experience of the advisor. That's going to be difficult too. So, I'll leave the value assessment to yourself. But really, the most important thing to think about is portfolio size and capital contributions. The more money you're investing on a regular basis, the more value you're probably going to get from having an advisor relationship, or the more money you already have accumulated. Again, probably the more value that you're going to receive as well. Okay, so let's get into some listener questions. The first question is from Simon. Thanks for your excellent podcast. If you have a family trust with a corporate beneficiary and you would like to distribute excess income from the trust into that private investment company, does it make sense to set up an additional company separate from the corporate beneficiary, or can the trust distribute to the corporate beneficiary? Simon, it can distribute to the corporate beneficiary and you can invest those monies in that company. So just for people that's listening, a family trust is often called a discretionary trust, which means that a trust will have primary beneficiaries and then secondary beneficiaries. The primary beneficiary might be mum and dad, and by definition in the trust deed, secondary beneficiaries might be, any entities related to them, grandchildren, children, parents, siblings, cousins, etc., etc. The definition, it tends to be pretty wide. And that means that a corporate beneficiary is a company, a private company that is your private company that's related to you, and they can become a beneficiary of that trust, which means that trust can distribute income or capital, whatever it might be, into that company. And what Simon's asking is that okay? Can I distribute the money into the company? And that's perfectly fine, exactly what we would do. The key thing, though, Simon, is to check who are the shareholders of that corporate beneficiary, because sometimes we see that they're not set up correctly. The shareholders to that corporate beneficiary should be the family trust. And the benefit of that is that you can distribute the money into the company. The tax is capped at 30%. You can go and invest that money. You keep a track record of the imputation credits, the franking credits. So that is all the tax that's been paid by that company. One day that company can pay out a dividend. When it pays out a dividend, it goes back up into the family trust because it's the shareholder. And then the trust can then distribute that dividend out as tax effectively as it likes. Now, sometimes we see the corporate beneficiary, the shareholders are actually the individuals. So it could be Simon, you could be you, spouse if you've got one, so forth. You don't want that to be the case. You want the shareholders of the corporate beneficiary to be the family trust. But great question there, Simon. It's always good to make sure it's set up correctly. Okay, next question is from Alex, and Alex has provided me a lot of details, which I appreciate, but just for the sake, because sometimes it can get a bit confusing just reading out numbers and loans and values and so forth on the podcast, and I don't want to confuse people. So I'm going to summarize Alex's question. Essentially, what Alex is asking is he has two investment properties, and he's split the loans for those investment properties, so 20% is secured by his home, and then he has a standalone loan solely secured by the investment property for the remaining 80%, which is exactly how I would structure loans. Except for the second investment property, it is owned tenants in common with his sister, and that 80% loan is with a different lender that's not going to match in terms of offer a better interest rate. And so what he's asking me is it okay if he refinances that loan, really changing the security for that loan from the property itself, so the property that's owned tenants in common with his sister, to be secured by one of his own properties, so his home, in order to get a better interest rate discount. And the questions really relate to, putting all your eggs in one basket, so having all your loans with one lender, and then any downsides to doing it. And Alex mentions that his wife and he are in their 50s and they're really focused on super, so they don't really have any plans for additional borrowings. It's a really good question, and there'd be no problems with doing it. If you put all your eggs in one basket, that is, have all your loans with one lender, that's not necessarily a problem. I mean, I like to try and split it up. If you're self-employed and you're doing all your banking with, one particular bank, it's ideal to do your personal investment borrowings with a different bank, just so you can control the information flow there. Otherwise, one bank holds, too much power. But if you're not self-employed and you don't have business banking, putting all your loans with one lender is not too bad, as long as they're structured correctly. So that is that a loan should never have more than two properties securing it. It's just one loan by one property. Now, you might, like in Alex's case, have several loans secured by one property, like your home, because they're relating to different investments. That's completely fine. But you don't want to have one loan secured by a home and investment property. That is, it's cross-secured. You want to avoid any cross-securitization. So if the loans are structured correctly, and Alex certainly has structured his correctly, it's not that big a deal, because you can always pull one loan away from that lender without upsetting the rest of the other loans, or upsetting or triggering valuations on any other properties and so forth. Of course, if you're not using the subject property as security, so the property that the debt relates to, then it's not a perfect use of equity. You're really using equity in another property and maybe retarding your ability to borrow again. But Alex has already addressed that to say that, he doesn't plan to borrow down the track. Of course, in Alex's situation, he's going to go and borrow or refinance that loan that's going to be secured by his property. His sister cannot be party to the loan, because the bank will say there's no benefit for her to be party to a debt that's secured by an asset that she doesn't own. So in Alex's situation, he will have to be the sole applicant, or maybe if Alex is a spouse, the spouse might have to be an applicant as well if they're on the title of the home. And that means that, he's on the hook for 100% of the debt. So he needs to consider whether that's a risk with his sibling. That comes down to probably a family relationship matter than a financial planning one. That would be one of the other considerations. But that's it, really. I think if you're comfortable with that, if you think, oh, well, it's not like your sister's going to run for the hills. I mean, you could put a caveat over the property that you own tenants in common with your sister, just to create some security for yourself, which means that she can't deal with that asset, which she can't anyway because you're on title, until she repays her portion of the loan. But as long as you're comfortable with that and you don't plan on borrowing down the track, then yes, refinancing that loan, securing it by your home, getting a better or lower interest rate is a perfectly fine thing to do. Okay, I'm going to squeeze one more question. Next question is from Ben. Ben writes, I'm one of your loyal listeners for the past couple of years. Your weekly podcasts have taught me so much. Thank you very much. I recently have one question hovering in my head that I need some advice from you. So thanks, Ben. Thanks for listening in, and I'm glad you appreciate the podcast. So Ben writes, we are in our early 50s and have about 2.4 million in super. We also own some residential investment properties outside super with net equity of about $2.5 million. Our business has $500,000 of cash in it, which is increasing each month. Both of us have reached the highest marginal tax rate. We're considering investing the cash surplus in the company, as you have suggested in one of your podcasts, using a company structure to establish a second super fund for both capital gain and tax saving. The question is it better to directly invest into a commercial property or into ETFs or anything else? The only purpose for this investment is for our future retirement and inheritance for our kids. Okay, Ben, thank you very much for the question. Yes, that episode, actually, I called it the third super fund. That was published on the 23rd of August 2023. Sorry, I didn't have episode numbers at that stage. I weren't using them, but I know that just because that's in front of me at the moment. Yeah, so that's a good one to look back. Here's a big distinguishing factor, though, Ben, is that I never, ever, ever would recommend investing in a trading company. Now, I guess to some degree it depends on what your business is and what risks might expose that company to. If you don't have any employees, for instance, if you're doing something that's extremely low risk, maybe, just maybe, you might get your head around it, but I think it's unlikely. The problem is that you don't want to invest in a trading company because you could be sued one day, anything related to, what business you do. And in fact, you said that you've got $500,000 cash in your company, which suggests that, you should pull out the balance sheet from the accounts, the most recent accounts that your accountant has done, and have a look at your retained earnings. If you have a lot of retained earnings in that company, that's a problem. That's a risk, because if you annoy me, Ben, and I'm one of your clients, and I get wind that, you've got $2 million of retained earnings, you're waving a big flag, please sue me. And so you really want to minimize retained earnings, which means paying out those profits, paying out those retained profits, and investing them in a entity that is non-trading, that doesn't have those risks. So that's what I'd investigate further. It's going to depend, the answer is going to depend on who owns the shares in the trading company and when you can pay out a dividend, or if you can pay out a dividend in a way that's tax effective. Hopefully you can. Hopefully your accountant has done the right job there. In which case then, distributing those monies into a non-trading investment company is a fine way to go. If you're early 50s, you already have equity in residential property, you've got a pretty healthy super balance. Would you go into a commercial property? Probably not, unless there was some substantial benefits to your business. That is, that there was, some goodwill associated with your locality or those sorts of things, or you need to spend a lot of money on a fit out. Otherwise, I'd probably keep it pretty simple and just have a liquid portfolio of ETFs and share investments and the like. But the key thing here is don't invest in a trading company. And that's why, the tax planning that you do at the beginning when you first set up a business, and making sure you've got a good holistic accountant, is incredibly important, because your investment approach, so your tax planning approach with the business, should be congruent and work nicely and seamlessly with your investment approach as well. Okay, I might leave it there for today. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.